Picture this: a government press conference, serious faces, flags in the background. Someone says, "We're creating money to support the economy." Sounds simple, sounds official. It's also mostly wrong, because the government doesn't actually create most of the money you use every day. Not your salary, not your rent money, not the number in your bank app right now. That money was created somewhere else, and understanding where it really comes from explains inflation, debt, housing bubbles, and why the system feels tilted even when no one looks like they're cheating. This matters right now because more money exists today than at any point in history. Prices are still high, debt is everywhere, and yet most people are blaming the wrong machine. So let's slow it down. Take out your phone, open your banking app. That number you see? It feels solid, earned, stored, but it's not cash. Physical cash, notes and coins, is a tiny slice of the system. In most countries, it's less than 10% of all money. The rest is digital. And here's the uncomfortable part. Most of that digital money is created when banks give out loans. Not the government, not the central bank, commercial banks. When a bank approves a mortgage, it doesn't hand you someone else's saved money. It types a number into existence. Loan approved, account credited, money created. At that exact moment, the total money supply grows. No printing presses, no tax debate, just a keyboard. This sounds illegal. It's not. It's how the system is designed. The bank creates the money. You create the debt, and they're born together. Now, where does the government fit in? Governments don't create money the way banks do. They mostly move it around. They tax, they spend, they borrow. When governments need more than taxes bring in, they issue bonds. Banks buy those bonds. Central banks step in to keep things stable. That's where the confusion starts. People see central banks and assume that's where money is born. But central banks mainly control the temperature, not the engine. They set interest rates. They decide how expensive borrowing is. They decide how fast or slow banks can create new money through loans, which means money creation is driven by incentives, not need. If borrowing is cheap, money expands. If borrowing is expensive, money contracts. This is where the irony kicks in. Money is created most aggressively when times are good, when assets are already rising, and it dries up when times are bad, when people need it most. That's not a bug. That's the design. So when you hear the government printed too much money, what often really happened is banks lent aggressively, assets inflated, and only later did policymakers step in to clean up the mess. By then, the money already exists. Prices have already moved. Wealth has already shifted. Zoom out, and this explains a lot. Why housing booms feel unstoppable. Why debt keeps growing even when everyone promises discipline. Why asset owners seem protected while cash savers fall behind. Money isn't created equally. It flows first through credit, and credit flows toward those who already qualify. So the real question isn't who prints the money. It's this: who gets access to newly created money first, and who only feels it later as higher prices? Because once you see that, the system stops looking confusing and starts looking very intentional.